How's it going, everybody? My name is Antonio, and you're about to watch my first in-person interview. I did this one while I was in London for a conference, and I made James Sykes, who, well, I guess most of you know who he is, but first of all, he's huge. Like, don't kid yourself from the videos, okay? Like, I'm 180 centimeters. Google says that's 5'11" in feet, which is for Belgium, at least. I'm doing literally average. I'm not landing supermodels, but my wife can cook and clean, so I'll be fine. But Sykes, though, he's like 6'9", and I'm only saying this because I felt small talking to him and I wanted to share my struggles. But so Sykes is a geologist who got his, how do you say, he cut his teeth, I guess, in the uranium industry right after college, working with Denison, and then eventually working with NexGen on Aero as well. And now he runs his own company, Baseload Energy. Fair disclaimer, an honest confession here, by the way. I still own Baseload, so I am biased. And also, they paid the room in which we record. The whole thing, everything basically is paid for by Baseload, just so you know. And Sykes also tried to bribe me, by the way, with this maple syrup. So I'm totally biased, and I can be bought with sweets, by the way, if you ever want to abduct me in a white van and you offer me some type of chocolate or something. I'm there. I'm sold. But so baseload is not what we talked about in this conversation. We talked about the valuations of uranium exploration companies specifically, and that's because I noticed that some of those exploration companies, actually specifically the ones in specifically Canada is considered a top tier exploration jurisdictions, right? So specifically those, but also even more so specifically uranium in the Athabasca Basin, because it's hosted by uraninite, which means that the metallurgy is more favorable than, say, a vanadium-hosted uranium deposit someplace else in the world. So these companies, they would drill rather good results, and when I say good results, I'm talking about the value of the rock that's in the ground. I guess a small side tangent here. Generally, it's a generalization, so it's a rule of thumb, I guess. The way that I've been thought is that when we are looking into an open pit deposit, that's roughly the depth of, let's say, maximum of 200 meters. It's a rule of thumb. There are exceptions, okay? The topography matters too and whatnot. But so if the project has the theoretical potential to be mined in an open pit setting, then the value of the ore needs to be at least $50 per ton. So for gold, for example, the open mine pit setting, the grade needs to be around 1 gram per ton. For uranium, that's roughly 0.05% of uranium at the current spot price. Again, rule of thumb, plenty of exceptions out there, but it's a good start. And then the underground, the deeper it goes, the higher the grade needs to be. So 4 grams per ton is sort of where it is for when it comes down to mining underground gold. And if it's not in situ uranium, but just traditional uranium mining, then it needs to be 0.2% uranium. Unless it's like a kilometer deep, then it probably changes. Actually, underground mining is very tricky, by the way. I don't understand why anybody gets involved in that. It just seems like failure is not only the norm in those, it's the expectation. Like engineers know, they go in knowing that they're likely to fail. That's why you generally need much higher grade than that to get people excited for the project. But so yeah, underground, you need roughly $200 per ton of ore in every, to process. It's not guaranteed that it will work, right? Okay, but it's a rule of thumb. If I say a rule of thumb one more time, by the way, you're allowed to click away. But so what I noticed is that some uranium exploration companies would drill like 0.5% of uranium or 1% of uranium, which is you're not exactly allowed to equate it to gold because it gives sense of a perspective. But 0.5% of uranium per ton means that there is 5 kilograms of uranium in every ton, if I'm not mistaken. So 5 kilograms is roughly 11 pounds. At the spot price of $50 today, that's $550 rock, or roughly 10 grams of gold per ton, which is very, very, very high grade if it were gold. And so these companies, these uranium explorers, they would drill 50 meters at 10 grams of gold equivalent, which is a 500 gram meter hole. Again, if it were gold, or 0.5% of uranium, and like 100 meters from the surface, so not deep, and their stock doesn't move. Or some companies would drill like, although much deeper, they would drill like $5,000, $10,000 rock, the equivalent of like 100 grams per ton or 200 grams per ton of gold per ton of ore, way beyond bonanza grade, and their stock wouldn't move either. Sometimes it'd stay like at a 30 or even a $50 million company, which would not be the case if it were a gold company. If a gold company drills 10 grams over 50 meters at 100 or 200 meters deep, especially if it's in Canada, stock will be taking off like like my wife is planning to take off if I keep on talking about uranium at the dinner table. But so that's not the case with uranium exploration companies. And it's not gold companies only, by the way. Even within the uranium space, if you look at the companies who, I don't want to mention any names, but who already have a feasibility study of some sorts, especially if it's a definitive feasibility study that shows the exact value of the project in let's call it a best case scenario, because that's really what these documents really are. But so these companies would trade at like 0.8 or 1 or 1.2 times their NPV, even if they're in Africa, which is well, it's not Canada. And that's not the case with gold companies, right? In Africa, they will generally trade at a severe discount to their NPV, which is understandable because another side tangent of something that I just recently learned, if the company is trading at 1.2 times the NPV, then that means that you're betting on them being able to increase their reserve in perpetuity, meaning, forever, because then your calculation goes from an annuity, which is how you'd calculate a reasonable price for a company that has an outstanding DFS, for example, to a perpetuity. And the way you calculate the value of a perpetuity is by dividing the cash flow by the discount rate, which for Africa, I know a lot of companies would run their feasibility studies at 5 or even 8%, but from having spoken to the analysts out there who do this full time, they analyze companies at 10%. But so if you run some of these calculations and they spend more complicated, by the way, I mean, everyone can run them. If you know me, then that everybody can do it. But then your blind pet rat can probably do it better than me. But so bottom line is, when I look at the uranium exploration companies that already have a discovery, and I value them relative to the gold exploration companies or silver, or insert your favorite metal here exploration companies, then they always come short relative to the value of the rocks. But then when I value the uranium developers versus the gold, silver, again, whatever type of developer it might be, then the developers come out as overvalued relative to them. But I don't know why that is. I don't even know if it's fair to value any of those stocks like that, by the way. I know I look all fancy and all that with my annuity and perpetuity, but I have no idea what I'm doing. And I don't know if that results in share price returns either, because something expensive can always get more expensive, right? While the cheaper thing can get even more cheaper. So that's a little bit of a long-winded, probably a 10-minute way of saying that that's what I talked to with James, and I asked about uranium exploration companies and to explain to me what else matters when valuing those besides the value of the rock and metallurgy, because, well, there must be something that makes uranium exploration companies less attractive to investors in other natural resource exploration companies, but there also must be something that makes uranium exploration companies specifically less attractive to uranium investors, because they value them much lower on a relative basis than they do the developers. So I'm ranting at this point, I know, and I was stressing out a little bit before the interview, so I definitely forgot to ask important questions here, but I know James likes talking about these stuff, so feel free to send him an email, by the way, if there are further questions, or post them below, but just don't expect me to give any meaningful answer myself, though I will stop by to say hi. And I'm ranting, I know. Let's play the clip.
It's a really good question. I honestly can't say why that is, but I would suspect people just don't really understand uranium results. But we also run into the whole problem that the Athabasca Basin has skewed people's perceptions of what good results are, what's required for uranium. So when people don't see your 10% or your 20%, they get a little bit offset. Or even if you don't have 1%, there's a lot of flack for that. But there's no reason for that. Anything 0.5%, even anything greater than 0.3%, 0.2% are quite attractive grades and should be considered as such, because there's no difference in Athabasca uranium versus uranium anywhere else in the world, really. It's all uranium. It's just different concentrations, but it all gets leached the same. It shouldn't, or grades anyway, don't really matter to the extent that what am I trying to say here? Yeah, so you don't need the high grades that you typically get out of Athabasca to have something that should be generating some interest in the market space. And I like I said, I just think it's people get skewed, or they just have a misconceived perception about what results should be in the Athabasca. But it's also explorcos anyway. Exploration companies don't get valued as much because people don't know what's in the ground. People want to see they want to see the NI 43-101s, they want to see the PFSs so that they can see some attributable numbers to the project. Whereas you can't do that with exploration. If you've just got a couple drill holes, like what we have for Accio, for example, we've got 80 drill holes in it, but we don't have any further metrics than that to say this is how many tons we have, this is what our grade is. This is gonna cost us how much to pull it out of the ground. We don't have any of that, so investors can't. They would have to do their own due diligence and figure that out on their own. Who wants to do that? They want to be told what to. Well, they just want to see a nice, something right there that a third party has come up with.
Right. I think I know what you're saying also, because you're saying uranium in the ground that's hosted by uraninite in this case is uranium in the ground. It doesn't really matter where it is. I guess where it might matter is the expenses and time for permitting and stuff like that. Like, because you mentioned Africa, I imagine in Africa it would matter more because it's cheaper and quicker to get into production over there.
Yeah.
But as long as it's hosted by uraninite, I mean, as long as the metallurgy is favorable, you can take it out of the ground. It's $1,000 rock. It's $1,000 rock. But are maybe some other expenses related to uranium, like, I don't know, mining obviously, but milling, transporting, or something that has to do with the radioactivity that makes it less profitable or something?
No, I wouldn't say that there's. It would be more social economics, I guess, that would make really the biggest differences. So in Africa, you've got lower wages. You do have lower trucking distances. You've got access to port facilities. So a lot of things really work out there. Just lower costs in general, especially for labor costs are not the same that you'd see in North America, where wages are much higher. Our costs overall in North America are just generally higher. So that's one reason why lower grades in Africa can work much more readily than North America.
And then also what matters is obviously the depth. That's also something you'd be mentioning. I was also referring to the costs actually between gold and uranium, for example, because we're using gold as an example. It could be another metal. Are the costs for taking uranium out of the ground higher than they are for gold in the Athabasca Basin?
That I don't know. I really don't know that answer. I would like to believe that it is easier or more cost effective, but it's really hard to justify that against a heap leaching gold scenario because it's pretty simplistic. However, uranium can also do heap leaching. If I'm not mistaken, there are operations that do that. So and typically uranium is much higher concentrations than than gold in the rock anyway. So 1 gram per ton is 1 ppm, and most of the mining companies or uranium mining companies in the world are at least 500 ppm. Some of them are lower than that. So you've already got a 500 times differential in the mineralogy that you want to extract, gold versus uranium, 1 gram per ton versus 500 ppm. Big difference. So theoretically, you should be able to extract more uranium in a heap leach scenario than gold. And yes, so instead of moving a ton of rock for 1 gram, you're moving a ton of rock for 500 ppm, and you're getting all of that. You're basically getting all of that out.
What about permitting to do all that? Because it has to do with radioactivity. I don't necessarily understand that either. If it's uranium core, can I touch it? Is it safe to work with? As it is with because it's gold ore, you can do whatever you want with it. But maybe therefore something to do with the permitting and the red tape around projects or something along those lines?
Permitting is definitely a thing. Environmental studies are also something that take some time and have to be done. The radioactivity is obviously the big thing to consider and to worry about. So yes, it's vastly different from gold in that way. Gold's very inert, and you can eat and drink gold and have no problems. Uranium, you'd have a lot of internal problems if you started eating uranium. Yeah. It would definitely not healthy for you. To touch it, yes, you can touch it safely. The alpha radiation is stopped by your skin, just that beta radiation and gamma radiation, which can penetrate through. That's why as soon as you ingest it, your internal organs are not as thick-skinned as your epidermis. So radiation would affect your internal organs quite readily.
Okay.
And that's in the uranium space, it's dust that is probably the biggest thing that you have to be concerned about in the mining scenario, is when you're blasting, you're going to create dust. So what people try to do though is just keep all the rocks wet as possible. And I've even seen blast mats used in some areas, which cover the rock, and then as it blasts, that blast mat, which is soaking wet, keeps all that dust suppressed.
Well, then, so maybe that's one of the reasons why the market is not attributing the value to, for example, in your case, baseload or ACCO, because they maybe expect because you're hoping to find something open pittable.
Yeah.
But maybe they don't believe that's ever going to be allowed in the Athabasca Basin, or they think that it's going to take like 20 years of red tape crossing to get it done. Could that be it?
That could be it as well. That could be very well it. I don't believe those time frames. I do think it is a lot quicker, and I do think ACCO will be mined, but yeah, it's a matter of when.
Sure. How would you go about it? I know you're a geologist, you're not a hedge fund manager or a CFA or anything, but how would you go about it if you had to value uranium exploration? Because we're talking about metallurgy here, we're talking about the depth of the project, grades, and all these things. What are you going to use, like an EV to pounds in the ground ratio? How would you value? How would you stick a number to it?
You'd have to separate the two first. Who's got a resource? That's a step there, and then even splitting those up. So how far are your resources along their way? Do they have PFSs?
What if they don't? It's just, green fields, or, I mean, not necessarily green fields, but just, they're just starting to drill. They've done 1, 2, 3, 5, whatever holes, just a little bit.
Okay. Basically, you're looking at the jurisdiction then, the lengths and the widths, and really, I try to use a GT calculation, so grade thickness, that anything over, I would consider anything over 5 GT to be very encouraging and should be followed up. So that could be 5 meters at 1%. That could be 10 meters at 0.5%. It could even be 50 meters at 0.1%. Something along those lines. I think once you hit those milestones, and that's meters times the percentage, not footage times percentages, because that will give you a different GT. I think once you start seeing those numbers, those are anything over a 10 GTs, even in the Athabasca, is something that you can hang a hat on. It's pretty encouraging. But then again, are you a kilometer deep, or are you 50 meters deep? That's a big difference.
So it sounds like you're saying that you have to try and determine the probability of the thing being mined, like stake a percentage, or it ever becoming an attractive enough project for a major to acquire.
But even from an investment standpoint, that doesn't really always ring true, because a lot of times investors are really looking for the grades and they're looking for the size. They're not considering the mineability of it.
But should they, or
absolutely
would that give me an edge over the market if I started doing that?
I think they should, but that's because I think that deposits should be mined. I'm not a fan of seeing deposits being discovered and thinking these are amazing deposits and then nothing happens to them. I've even seen that in my career, and so that has even skewed my perception of what investors should be looking at. But I can see from, I guess, recent examples throughout the year, you've got some great companies with some great resources out there, and their share prices are absolutely phenomenal. It's been great in that regards. Then you start looking at where they sit in the whole grand scheme of things, and they're at those depths with as much sandstone cover as other deposits that just haven't moved in 50 odd years. So is the valuation correct? Honestly, don't know, but it's all speculation. Everyone thinks that a lot of these deposits can be mined. Great, just start proving it then. And it's a difficult scenario. If we're always looking for the monster deposits. We want to find a pod 2 McArthur River. We want to find 250 million pounds, but we want that to be open pittable. We don't want that to be at anywhere in the sandstone. But we're not going to say no to anything less than that as well. That's our goal, that's our objective. But if you're coming up with, with a tenth of even what Arrow has, I think that's a lucrative deposit, depending on where you are. If you are showing positive economics, so if you do have simplistic mining scenarios and your capexes are low and your opexes are low, those are the type of things that I think would move. And we've seen that. Cluff Lake, I use Cluff Lake as a great example. There were 10 deposits that they mined there, and they extracted 60 million pounds. But if you start looking at some of those deposits that they mined, like there were 3 open pits that were about 300,000 pounds each. There was an underground, their test mine for underground working was less than 100,000 pounds of uranium that they mined. This was a predecessor to Orano, so Kojima, and even prior to Kojima. If you are a big company like that, are you going to put a mine into production to lose money? I would like to believe not. I would like to believe that they would have strong fundamental decisions and rigorous processes in place to say, hey, look, we're going to mine this. We're going to do underground mining for this little 100,000 pounds of uranium, and we're going to make money on it. That's what I would expect from the people running these companies. So if you're mining less than 100,000 pounds of uranium in an underground environment, if you're open pitting these 300,000 pound deposits, that's proof right there that it's doable. It's done. You don't need 200 million pounds. You don't need these monsters all the time. These little things work very nicely. Recently, I came up with what I thought was a good analogy. If you go to a restaurant, you want to order fish, you don't order the minnow, you don't order the shark. You go for the nice, smaller, tasty fish. So like your salmon or your trout. Not super big in size, not super small, just the right size.
It also sounds to me like there could be a list of things to go through if you're trying to determine the probability of that project eventually being mined. I wrote some things down, so you get the jurisdictions where you start, because it's related to the cost. It's also related to the regulational red tape around it. Depth, we've been talking about that. You mentioned capex, opex. What are some other things like infrastructure, the probability of getting infrastructure there, like roads?
Yep, that's a big key. If you're out in the middle of nowhere, how difficult it's going to be to get something mined. Ring of Fire in Ontario. I'm not sure if you're familiar with that jurisdiction. A lot of good chromium deposits. They've got the Eagle nickel deposit out there, which is one of the best in Canada, undeveloped nickel. And that whole area has just been plagued for a long time because they had to put in a long road. It was a very costly road to get up there. So again, yes, things like that certainly make sense. Yeah, the environmental side of it, the social economic side of things. So are the stakeholders, are the northern stakeholders and Indigenous in the area, are they part of the whole strategy moving forward? Are they buying into it? Are they supporting it? So that's definitely a consideration as well. Look at Northern Australia, where the Indigenous are saying, no, we don't want to see any more uranium mining or exploration in this area. It's everything really, really counts and builds up. And it's not a simple little list of things that will work for every area. Every area has its own unique set of things that they have to overcome.
What about topography or something like if you're on top of a mountain? Is that something you would look at as well?
Yeah, topography makes a big difference, which is why we're happy where we are. It's all flat.
Okay,
it's very easy to work with
because it's a basin. What if you're somewhere else? What are red flags in terms of topography? Like I mentioned, sometimes I would see these photos and they say like, okay, our deposit is here, and it's like literally on top of a mountain. It kind of gets me a little bit worried. But is that a thing? Like, can you take the mountain out of there? Or like,
yeah, no, there's a lot of deposits in the mountains. As far as uranium goes, I don't think so. But you look at a lot of copper and gold, and it works very well.
So there's no red flags necessarily when it comes down to topography.
It's just harder. If you're working up the mountain, same thing. You got to put a road up the mountain. That's not an easy task. So it's just a little bit more problematic than if you're operating on in a flat environment.
I guess it goes back to the value of the project, because if you have to build a infrastructure for 500 kilometers where you're going to Arrow, well, you're gonna make that work, right? Because it's what is it, six, seven, $10,000 rock, whatever it is. I don't know off the top of my head, but it's eventually it's gonna come down. Eventually, it goes down to the margin. So you start
Yes,
looking at it as a business. You look at it,
exactly.
okay, what is this gonna cost before it's built? Once it's built, how much is it gonna cost to run it? And then how much are they going to be selling that rock for? And then what's left at the end?
Exactly.
And so,
That's the name of the game right there. Yeah, it is all margin based by
hmm,
that point.
but it's by that point, and we're specifically, I mean, I specifically wanted to focus on,
Yes.
pre-discovery companies. What do I do is it's a checklist. These are good things that we went through, but as a checklist, because you said it's not as simple as a checklist, but what do I do? Like if you're an investor or your life depended on it and you had to invest for it, how would you go about it? There's what, maybe 30 pre-discovery companies, something along those lines right now, and you had to go through them. How do you start? What are some of the first things you look at?
I look in the area that they're in, the country. Some countries are more favorable. The management, do they have they repeated success? And the area that they're working in from a geological perspective. I guess if a lot of people aren't geologists. So you just start looking at comparative plays within the area. Are you into an area that has not seen any exploration for that commodity? Well, that's a much riskier venture than somebody who's going into the Athabasca, which is a known jurisdiction. So that the geology does come into play in that regards. Um, pre-discovery, it's really tough. Everybody has the same chance to a certain degree, but if I think geologists have that benefit of knowing, you can look at the geophysics of the area and say, oh, that looks interesting.
Mm.
Um, I don't know if the average investor can do such things as well.
No, I mean I can't do it, so.
Yeah, so there are some limitations of on what you can do to really assess the companies. Was there previous drilling in these areas? What were the results from those? Again, are you seeing things that are getting towards that 10 GT level? But by
Mm.
that point, even before 10 GT, you could have something that's 1 GT, and that's there. You're on a discovery.
Mm.
Um, Previous drilling, do they have uranium in general? So a lot of people love to throw out the word pathfinder elements. So, oh yeah, we've got pathfinder elements for uranium. Like, really, the best pathfinder for uranium is uranium. So does your project have uranium? Because if it doesn't, you can have all the pathfinders you want. If there's no uranium,
Mm.
what are your pathfinders telling you? So do your projects have uranium?
To what is the end goal of that analysis? Because you're either going to go into production or you're going to be taken out by a major, and so you're looking to figure out if this is something that can go into production or could be taken out by a major. That's sort of the end analysis, the end goal of your analysis.
There's no one real end goal, just whatever would benefit the shareholders in at that time and in that circumstance. Uh, you got to keep all doors open and try to real. Uh, Sorry, are you asking from the investor perspective?
Yeah, from the investor perspective, like I'm a retail investor, I'm sitting at home and I'm like, okay, I want to analyze this company. What am I analyzing it for? Am I looking at it, okay, is this attractive enough for somebody else to
You
pick
want to
up?
make money.
Yeah.
Yeah, you want to make money, so it doesn't matter if they're going to production or not. All that matters is the return on the investment, how quick they're going to make that return for you. And results are the best way to do it.
Hmm.
Um,
But so if it's a small company,
it's a small company with no results, and they've got nothing but exploration dreams like everybody else does.
but they're at the front door of one of the bigger companies
Yeah,
or one of
yeah.
the projects of the bigger companies, would
The
that mean that you
proximity
should
plays.
stick? Yeah,
Yeah,
yeah.
proximity plays are a good thing. It's because these things usually do occur as pearls on a string. Not just uranium, but a lot of deposits within the world. They're all kind of pearls on a string. They're all structurally controlled to some degree. So if you're in a proximity play, if you can kind of see a trend of potential mineralization you have, and then that that company has that same trend, just either whichever direction, north, south, east, west, definitely I would say they would have a better potential of success than a company not on that trend.
But that would mean that you have to figure out what the potential
Yes.
who the potential acquirer might be. Obviously, if they're at the front, if they're at the doorstep of another company, that would be easy. But you also have to know what they look for. So what do majors look for? Are they scared of deposits that are a kilometer deep, or do they also look only for margin? Is that the last thing that matters for them as well?
No idea. I can't answer on the big company side. I would like to believe that they only focus on margin, to be honest. It makes sense for me. But yeah, I can't answer for them. How many Athabasca deposits have been put into production at kilometer depth? Zero. Why? Is it because they're afraid or they see negative margins?
It sounds like an engineering challenge too,
Absolutely.
especially
And
if
that's been proven, both McArthur River and Cigar Lake. They both flooded twice. That sandstone is an engineering nightmare. How many of these Athabasca deposits are still in the ground? There's billions of pounds that are in the ground and they've been there for 40, 50 odd years. Billion pounds. That's not a small number. That would power the world for decades. And they sit there and they languish.
So maybe they're looking for something that's on the same trend as you said, and it's less of an engineering nightmare.
But again, if you're the investor and you just want to make a profit off your investment, how far do you want to carry that through? Do you want to be with a company that goes from the discovery to the production stage, or do you want to get out at the discovery level, which most people want to do? So being in the sandstone, like being in the Athabasca for the discoveries, not an issue at all. That's a great place for investors to really profit from, to be absolutely honest, because there are a number of discoveries. Vision 3.0. I don't know if I should name drop. Can edit that part anyway. But look at the results that they just had. Absolutely great results, radioactivity results, and it looks like it's going to build into something big. But that's one of those situations where their stock price just shot up. They were at what, 2 cents or 4 cents, and now they're trading at 20 cents just off one drill hole with no U3O8 assay results, all radioactivity results. How deep are they? They're over 200 meters deep. They've got 100 meters of overburden sandstone, and then they're into basement rocks as well. So that being in the basement rocks looks pretty attractive. But that's it. Like if you got in at 2 cents and you got out at 20 cents, you've already had a 10 bagger right there. Do you really need to ride the rest of the way? That's up to the person, but that getting to that discovery is, it's generated a lot of cash for a lot of investors.
Do you think, I mean, you as a geologist, as a company operator, do you think that's where the best risk reward is, like waiting, getting out at the discovery, or what about getting in at the discovery and then waiting until first production, or waiting until the company actually gets acquired? Because that way you sort of have you have a what do you call it, a bottom line basically. I mean, the value of the company cannot go below that, because it has something. Because if you getting pre-exploration, they maybe have absolutely nothing and the company goes to zero, and that company is always going to be worth something. So your downside is limited. But then to the upside, if it's a proximity play, it can get acquired maybe for 20 times more than what you bought it right after discovery. How do you see the risk reward there?
I'd say the risk reward is pretty good still. Yeah, absolutely. Let's use NexGen as an example. NexGen, we made the discovery. We were floating around 40 cents. It took us a while to get up to 60 cents. The share price didn't really start moving until the 43-101 came out, and really until after COVID. And that's when the price of uranium also started coming up. They had done a wonderful job of just marketing the deposit, marketing the company. It is looking like it's definitely one of the best uranium deposits in the world, bar none. There's no doubt about it. And so people have seen that. And as the price of uranium started going up, NexGen's valuations kept going up. So it took a while. So you could have been in that situation. You could have got into NexGen post discovery and still had a significant return on your investment.
Why is nobody buying NexGen? If it's and I mean, they're always saying that it's going to be into production. I spoke to Lee Courier. He told me it's going to be into production this cycle. He wasn't super clear. He didn't say I absolutely want to take this into production and I'm not selling. He was, well, like, I'm going to do what's best for the shareholder. If an offer comes along, it's good enough, I'm going to sell it, or I'm going to raise the vote and vote for it to be sold. That's what it comes down to. But why has nobody bought it yet?
No idea.
Like Cameco was raising a lot of money a couple of months ago before the Westinghouse deal. There was a lot of speculation about that, like they're going to buy NexGen, and it made a lot of sense to me at first as well. So, what do you think is happening there? Maybe there's an answer for retail investors there to look for, like, okay, NexGen's not yet getting bought, but the market cap is still high. So a lot of people made a lot of money, but it's not yet being taken out, and it's not into production either.
So their story's not done, not even close.
Okay.
Can they go up? Why not?
We're almost at the end here, James, because I know that you have to leave. Is there something that you think we should be talking about when it comes down to the valuations of small uranium companies that we're missing here? I think metallurgy, but again,
that's pre-discovery though.
Yeah,
metallurgy wouldn't really factor in. I would say keep it simple, keep it to the jurisdiction. If I'm a uranium exploration company and I all of a sudden say, hey, look, I'm in London, England, and I'm going to be exploring for uranium here, why would you invest in something like that? So jurisdiction does really matter, and just again, proximity, the management track record of these guys who've made discoveries, whether it's uranium or not. Have they had a successful career down the road? Are they, what are the type of people running the company? Now that uranium's hot, as what happens with almost every commodity that goes through these cycles of what's the hot topic of the year, you get a lot of new companies that just come in and they're like, hey, let's ride this wave, and then they'll two years down the road they switch to another commodity and let's ride this wave, and so they're not really into it. I would consider that to be not a serious company. So pay attention for things like that. That should definitely be weighted within ranking or evaluating a junior exploration company for sure.
It's not as easy to stick a valuation to it. So maybe that's the thing, because if you're looking at a DFS, there's a bunch of calculations, ratios that somebody else already made for you. You just have to run the numbers through it. You come up with a valuation at the end, and it's a yes or it's a no. That's pretty much it, I guess. But when it comes down to smaller companies, it's not as easy to do that. So that might mean two things. Maybe that's one of the reasons why some of these companies are undervalued, because maybe it's hard for people to understand their value, which would mean you have to pay close attention to the person telling the story. So you have to pay a close attention to the CEO, and if they're able to tell the story, to attribute the right value to it, not over promote, make it unsustainable, but not also, not do anything and don't tell anybody about this story, which is a great story. So somewhere in between. And but that also creates, second thing is that I guess that creates opportunity too, right? Because you could look into something, you can go through all these things and many other things, many other previous discussions that we've had, and figure out that, okay, this has real value, but nobody's paying attention to it, and that can give you the opportunity or that edge. So yeah.
Even share price, I think share price should be considered. Difference in investing in two exploration companies, one's at $2, one's at 2 cents. Both have no results. They're both in the same area. 2 cents probably has more dilution, more shares outstanding than a $2 company, but it's something like that. So if you don't have a lot of outstanding shares, you can get a much better appreciation on a discovery. But even in the uranium world, you don't need that either, because as the price of uranium rises, all boats rise with the tide. So you're a company with fewer outstanding shares would do better in that situation.
Yep, because there's and the float is tighter, and also I guess also looking at the fully diluted shares, that you don't have too many warrants and options because they can be a drag on the share price. If the share price starts climbing, they can sort of be a drag on the share price because it sort of creates an uncontrollable selling that the company cannot control when it comes down to the options and warrants. So that's a good point. That's a good note to make as well. I think we've been through most of those. Again, you gotta be on the road here in a couple of minutes. Is there anything that I'm forgetting to ask you about?
I think I've tried to ramble my answers as best as possible.
I think it was a good interview. Thank you for being here today.
Thank you very much. Pleasure.